So today I'm just going to talk a little bit about kind of the shorter term and longer term risks that I kind of monitor or am seeing in Canada. And just to kind of go over them, there's really 5 things that I really want to talk about. The first, we obviously have to talk about trade. That's pretty much dominating the news and is ultimately the kind of biggest near-term risk we're facing in Canada. And there's a couple of facets to that I'll talk about. The second one, more domestically oriented, we got to talk about household debt and housing because that's pretty much on the minds of a lot of Canadians on a regular basis that I talk to, certainly. And then we'll talk a little bit about some longer-term issues that I'm seeing, and certainly ones that PEI and more Atlantic Canada more broadly are facing. For example, the aging population, and how does that play out, or how does it manifest itself in any number of ways? Housing is actually a big one for me. And then we'll talk a bit about productivity challenges and inequality pressures as a consequence of those 2 factors. So that's kind of the scope of the presentation. So I'm just going to dive right in. Trade, obviously the number one biggest risk to Canada right now. NAFTA is being renegotiated. The numbers I put up behind me are kind of estimates of impacts that people have put out there. But NAFTA is kind of a tricky situation. Like, I'm sure you've all read about Mexico and the US coming together to form this bilateral deal, this agreement. And a lot of people are talking about, hey, that's going to put a lot of pressure on Canada to accept that deal or do something hasty to be part of that deal. And to some extent, that's actually true. But one of the key things about NAFTA is it was a trilateral process that in the US was ratified by Congress. It can only be done in the exact same way. The president or the US and Mexico cannot unilaterally just say, yeah, we got a deal, this is the new NAFTA, forget about Canada. Canada has to agree to it, and then ultimately at the end of that, Congress has to ratify that deal. So if we think about what all this pressure they're putting on them, it is a little bit of posturing to say, hey, you better make a decision now or else you're going to get left out in the cold, which is absolutely not true, or at least not entirely true. Certainly Canada is under pressure, but it's only to a certain extent. And the other thing that we need to consider is that if the president has made all these threats about just tearing up NAFTA, again, same deal. If he tries to dissolve NAFTA outright, again, requires congressional approval, and there's already been quite a lot of bipartisan, in particular Republican kind of angst about that. A lot of Republicans have already said that they're not going to support that because a lot of those states consider, or actually, Canada is their largest trading partner. Canada is the largest trading partner of 37 different states, a lot of those red states. And so NAFTA, if it gets dissolved, is going to be as big of a hit to those states as it would to Canada. So there's already quite a lot of support for NAFTA, for Canada to be at the table. So there's, there has to go through the proper process. And so, there's all this posturing happening right now, but I would caution against kind of reading too much into that. That being said, it is ultimately quite significant. These effects are nothing to sneeze at. Like, these are really serious effects. And the reason for that, we are still very, very highly leveraged to the US from a trade perspective. We've been talking about trade diversification for decades. If I recall correctly, Trudeau the first was actually, I think, one of the first prime ministers to actually go to China and say, oh, there's a lot of potential in China. We should be diversifying our trade there. And that was back in, I think, 1971, 72, something like that. So we've been talking about trade diversification for decades. And yet, as you can see, we've had very, very limited success. Back in the 80s, the US accounted for about over 80% of our trade. Today, they're about 75. So we've diversified a little bit, but we are still highly, highly leveraged to the US. So whatever happens in the trade file is going to hit very, very hard. So it's definitely a significant risk. We have diversified a little in terms of trading more with Europe, for example. We've increased our increased trade with Europe by about 3.3 percentage points. So that's not insignificant. China, we've seen a little bit of improvement. India, same deal. So we are seeing that move towards other trading partners, but it is not nearly as significant as we would have liked back when we first started talking about this file. So it's a significant risk, and PEI actually shares a very similar trade exposure. So pulling up these stats from Industry Canada, PEI alone exports almost 1.4 billion goods, just goods, forget about services, just goods, to the US, and it makes up something like 73% of total exports. And of those, just 4 industries make up about 50% of total trade to the US. So 4 industries, exports to the US, that's half of PEI's trade, and you can see them on the board. Frozen food manufacturing, seafood, and then some higher value add manufacturing. You guys would probably know what companies are actually in that better than I would, but that's not insignificant. So PEI has as much to lose if NAFTA does ultimately kind of get dissolved as the rest of Canada. But given the uncertainty around how those negotiations will go, one thing I didn't mention is that even if NAFTA does get dissolved, there's still question about whether or not the original Canada-US Free Trade Agreement would then take over, and that's, it's not as good as NAFTA was, but it's still something. So there's tons of uncertainty around this particular piece of the trade file. So I would say NAFTA, maybe not the biggest risk for me. For me, the actual bigger risk is the auto sector. So if NAFTA doesn't ultimately get resolved, remember we have the midterm elections coming up too. So if they don't get a deal before November 4th when the elections happen, all of those elections are favoring the Democrats. And if the Democrats take the House or the Senate or both, most likely the House, they can actually act as a check on the president's power to actually pass any kind of a deal. But he has made serious threats that if NAFTA isn't renegotiated, that he will impose these very significant auto tariffs on Canada. And that's actually the bigger risk because the president can unilaterally make those determinations. There's this section of, I don't know if it's the Constitution or some trade act, that basically allows the president to do these kinds of trade actions under quote unquote national security concerns. And he has used that specious, very specious reasoning to levy all kinds of tariffs, steel and aluminum tariffs that we've all heard about more recently, tariffs on China, for example. He's done a lot of serious damage to global trade unilaterally based on this kind of one act that he's referencing. That, obviously we're not an actual national security concern, but he's still able to do it. So if these auto tariffs actually go through, some estimates are of the impact are quite significant. Autos and parts alone make up 20% of total Canadian trade. That's exports and imports, because of how integrated the auto sectors are between the US, Canada, and Mexico. If we look at Ontario, where autos is more concentrated, it's like 40%. So this is a serious impact that could, we could see something like a 1 to 1.5 percentage point hit to GDP over a 12 to 18 month period. Now, in and of itself, that may not be a huge risk, or that may not be the biggest impact we've ever seen. But it technically would be considered a recession if it's over that long a period of time. And what's most worrying is this potentially the straw that breaks the camel's back? Canada is not without its own domestic risks. And does this kind of act as that trigger point to say, well, if we have all these other problems, do they start unwinding because of what's happening on the trade file? So obviously the biggest risk I'm talking about is household debt. So you've all probably heard the statistics, household debt at record levels, something like 170%. The chart you see here is actually a number I've created that's the US equivalent definition. So the US and Canada measure household debt differently. To make sure they're actually apples to apples comparisons, we need to do a little few tweaks. So the Canadian numbers won't be exactly the same as what you would read in the papers, but it's actually comparable. And you can see what happened. So in the US, between about 2002 to about 2008, that's when we saw that housing bubble build. We saw all these subprime mortgages start entering the system, and it built and built and built until the bubble crashed or burst. And then all this deleveraging happened. People were defaulting, people were losing their jobs, banks weren't lending out money, and so you had the debt-to-income ratio drop dramatically as a consequence of all of those factors. Well, take a look at what's happened to Canada. We've well surpassed where the US has gone. Our household debt-to-income ratio has more than doubled over this period of time, well beyond where the US was. And so on the surface, this looks incredibly scary. So the real question is, if trade is the kind of risk or the straw that breaks the camel's back, does this act as kind of a secondary hit that brings down the Canadian economy even further as big of a risk as this is? Now, what this has ultimately driven is obviously home prices. Household debt, 75% of that is in mortgage credit. So really, the increase in household debt that we've seen has pretty much almost all gone entirely into housing. Now, I'm showing you Vancouver and Toronto because it's all over the news and that's all we really talk about. But surprisingly, PEI housing stats, not that easy to find. I was surprised to say, but ultimately I was able to find some numbers. And even though Vancouver and Toronto have seen the largest or the most severe home price pressures, it's not like PEI has been left out in the cold either. Home prices have increased quite significantly here as well. So in the last month, we are starting to see some moderation in prices in PEI, but growth is still going pretty strongly. If I look at the numbers here, growth in the last month was down by about 1.2% in the last month, but year to date, home prices are, for the first 7 months of the year, home prices are still up 3.1% from last year, and that's after all of the gains you've seen over the last 10 years. So home prices here are quite significant, and inventories are quite low. So if we take the current sales kind of pace, however many sales happen in a particular year, and we look at how much supply is actually out there, the time it'll take to consume the entire supply of housing is about 5.3 months, which is really, really, really low relative to the historical average, which is about a year. So the pace of sales is extremely fast, and that's putting those upward pressure on prices. And we're seeing all that in the household debt metrics. So household debt, housing, intricately tied as a major domestic risk. It's the biggest domestic risk that Canada faces today, and certainly that's, I think, true across every province. Like, there is no province that is excluded from that. So the thing about this, though, is that I have maybe slightly a different view about housing, and here's why. The thing about housing is if we look at the US and we look at what drove home prices in the US, there was a particular kind of narrative that you all read about. Subprime mortgages, mortgage-backed securities, all of those kind of factors kind of commingling to create this bubble thing that ultimately burst and brought home prices down. But the start of that, the unsustainability of that home price kind of trajectory in the US was driven by subprime mortgages, was driven by bad credit quality, borrowers taking on mortgages that they simply could not afford, and that was kind of what was pushing up home prices, and that was ultimately what was unsustainable. You could never just have all these borrowers that couldn't afford their mortgages just continue to prop up the housing market. So the real question for us is, we have these very scary household debt statistics. Home prices are as high as they've ever been and unaffordable for a lot of the Canadian population. So are we seeing the same thing? Are we seeing the same kind of unsustainable credit growth, poor quality credit growth that we saw in the US? And it might surprise you to hear that the answer is actually no. So this data actually comes from Equifax and CMHC. So notionally should cover, CMHC being the Canada Mortgage and Housing Corporation, the company or the Crown Corporation that would insure a lot of the mortgages that happen in Canada. So notionally, this should cover a lot of the mortgages that get originated across the country, and the data show that credit quality is actually getting better. So the people that are pushing up the home prices in Canada are actually, supposedly, actually able to afford those mortgages. So that, I think, is the real head scratcher here, is that how are we seeing home prices get pushed up so high and yet not see any deterioration in the credit quality of those borrowers? And that's kind of so that's the question that I think we need to be talking about, is where all this capital is coming from, or where all this income is coming from. So anyway, without that kind of unsustainability in credit, it's hard to picture, the home prices, the home price picture and the household debt picture really kind of, it's hard to see the blue line following the green line. That's kind of the basics of it, without something else to be that ultimate trigger to drive it downwards. So it's still a huge risk. It's a definite risk, and it's the top #1 risk in my book. But ultimately, it's not going to be that kind of internally driven kind of recession that we saw in the US. It could get triggered by a trade shock, by an unemployment rate shock, by an interest rate shock, something along those lines, but it probably won't be just this kind of natural downturn in housing as we saw in the US. Now, that's kind of covering the short-term picture. From a longer-term perspective, there's 3 areas that I wanted to talk about, and they're all related. And it has to do with where we are headed as a country, I think. And the basics of that is in our demographics. Now, what I have up here is the breakdown of the Canadian population by age cohort between 1971 and last year. And what you can see, back in 1971, there was this really, really big population, those really long green bars at the bottom, between the ages of about 0 and 25. And that was the baby boomer population. they were, they're still the biggest population in Canada, and and as they have aged, they have moved through those age cohorts. So back in 1971, they made up about 40% of the population. Now, as they've aged, we've also had, the baby boomers have had children, they've grown up, we've seen a lot of immigration, mostly on the younger side. That's kind of evened out the distribution, but the baby boomer population still is extremely significant and make up about 27% of the population today. So now we're actually looking down the barrel of 27% of the population retiring in a very short window of time, and not a lot of folks behind that to make up the ranks. So there's a real challenge here when it comes to, for example, labor force growth, employment growth, that this demographic profile is manifesting itself. And in actual fact, like, I always point to this as a really interesting analogy to why home prices are rising as fast as they are. For example, there's this big bulge in the population. Most of them would own homes, and they would take up a certain portion of the housing supply. Their children, we call them the echo boomers, are actually all entering this perfect, quote unquote, age window where they're now all getting married, everyone's having a family, everyone wants to buy a home, all at the exact same time. They're quite large as well. I think they're about a similar size to the baby boomer population today. So now you have a population that's taking up a lot of the housing supply. They're not downsizing yet. In fact, we're not seeing a lot of baby boomers downsizing at all. And on the same token, that next generation is trying to enter the housing market. So now you have this double whammy of increasing demand but not enough supply, and that's actually one of the factors of why housing prices are as high as they are. So this is actually manifesting itself in a lot of different ways. And PEI, in PEI, the pressures are just greater. You can see how much longer those green bars were in 1971, and how still very large those bars are today in 2017. So, however this demographic bulge, this kind of aging of the population manifests, those pressures are just going to be greater in PEI. Now, so the consequence of that is basically as the baby boomers leave the labor force, that's going to put pressure. As they leave the labor force, that's going to put pressure on our overall economic growth. So if you think about what GDP is, it's just how many people do you have working in your economy multiplied by how productive they are, how much they produce on a dollar basis every year. So if you have all these people leaving the labor force and no longer working and retiring, well, then you have to have something make up the difference. Either that's a younger labor force moving in to pick up the slack, which is actually not happening because we just don't have the demographics. We don't have the numbers to make that up. It's actually just simple math. Or you raise productivity. And so I'll get to the productivity bit in a little bit. But basically, if you look at where our population is today, and you don't make any kind of assumption about rising labor force participation rates or whatever that case may be, our growth rates are looking pretty dim. Now, this isn't technically a problem that's exclusive to Canada. Pretty much every advanced nation is facing this problem. But on the same token, every advanced nation is trying to solve this problem. Like, how do you think about this? How do you get around this issue? Now, one of the main reasons we worry about it also is, we have all these kind of social security programs that help protect older people later in life, OAS, GIS, for example, healthcare spending, things of that nature. As we have this kind of, not disconnect, but this imbalance between the working population and the elderly population, it does call into question how sustainable some of those programs are going to be. So what I have up here is called the old age dependency ratio, which is the share of the population that's between the ages of 15 and 64, so that kind of prime working age population, as a share of the elderly population, so people 65 and over. So it gives you an idea of how many people are kind of putting into the system versus how many people are taking out of the system. Now, back in the 1970s, it was about 8 to 1. So you had 8 working people for every 1 elderly person. That was a pretty good balance. You could have a lot of income, a lot of tax dollars to fund a lot of retirement programs. But as the population ages, we are seeing less and less working people, and we are seeing more and more elderly people. So, I mean, if we look out based on Statistics Canada's projections, Today, that figure's about 4 to 1. So we've already seen that halved between the early 1970s and now. In 20 years, it's going to be about 2.5 to 1. And by 2060, we'll be approaching 2 to 1. So that's 2 working people for every 1 elderly person. So that's a serious thing that we need to be talking about. Again, the issue for PEI is whatever's happening across the country, the pressures on PEI are going to be that much greater. You ready to see the numbers? So the blue line is Canada, the one you just saw, and the green line is PEI. So I said by 2060, we'll be approaching 2 to 1. Within the next 20 years, PEI is going to be at 2 to 1. So now, these are provincial numbers, and it's not quite fair to say that. So a lot of these programs are kind of national in nature. So it's looking at the provincial numbers isn't entirely comparable, but it does give you a sense about what kind of pressures the province is going to be facing over the long term. Like this is kind of a serious issue. So we talk about this. So that's one aspect of it. I guess the other aspect of it is, well, how do we fix this problem? How do we kind of solve for it? Immigration is going to play some role. In fact, immigration has played a very large role in this province's very recent history, let's say over the last 10 years. But it can't be everything. It's not going to be everything. Like if you look at kind of StatsCan's forecast for where we're headed, net immigration is already going to account for 100% of net population growth. So that means basically that the number of births is going to be roughly equal to the number of deaths, and the only population growth we get is from immigration. That's essentially what that number is saying. And that simply, we can't just we can't just bring in newcomers to make up for that loss of labor force growth. Again, the math isn't there. We would need to bring in just crazy amounts of newcomers in order to make up that shortfall. So the answer isn't here. I will say though that PEI has actually done a very good job of kind of being at the forefront of the immigration debate. Like PEI and Manitoba were one of the first provinces, the first 2 provinces in fact, to implement what were known as provincial nominee programs. So kind of a fast-tracked way of bringing in newcomers specifically to help, labor force growth and all these different kinds of things. And if you look at kind of nationally how many immigrants are coming into the country, it's about 0.8, 0.9% of the population. In PEI, it's about 1 to 2% of the population. So I think PEI has done a better job of trying to attract more newcomers and trying to integrate them than kind of Canada as a whole. But again, it's just not going to fix the problem. Like the math isn't in anyone's favor. So then the way we get out of this, or what people are focused on, is the other side of the equation. If you can't fix here's the number of people working in my economy section, you look at the productivity side. But even there, unfortunately, our track record is really not that great. You look at how much productivity growth we were seeing in the 60s and 70s, anywhere from 2% to all the way upwards of almost 4% over the course of those decades. That has slowly come down and down and down and down and down. So now we're only looking at something about 1% productivity growth. So if you add productivity growth to labor force growth, that's kind of what your prospects are for your long term. So I guess the reason I'm talking about this is that these 2 factors are ultimately what drives kind of Canada's standard of living. Our economic success determines our standard of living. So if we can't resolve this labor force issue, then we have to talk about the productivity issue, which is why every company under the sun, every government, every company is talking about innovation. How do we be more innovative? How do we be more productive? How do we get more for less? That's the conversation that we're having at a national level and on a more micro level within every company. So that's kind of where the focus is. But for me, there's a real challenge in thinking about productivity these days. Actually, for a second, I just want to go back to this slide. If we look back in the 60s and 70s, that was a particular era of the Canadian economy that large focus on manufacturing and autos and certain resource sectors and things like that. It was kind of easy to think about what productivity gains look like for those industries. You put in a new machine and your workers become more productive and you can produce more for the same labor input. Great, more output. But we have migrated away from that towards what is today our knowledge-based, services-based economy. So what does productivity gains look like in a knowledge-based, services-based economy? Notionally we can think about new technology, automation, machine learning and things like that, but I think it's conceptually hard to think about how do we continue to generate? How do we go back to the 60s and 70s era productivity growth rates? Like, is that even feasible? And it's an open question for a lot of economists and policymakers. We don't know. We don't know how to get back to that, if it's even possible. And there's another issue too, is that as we've seen productivity gains, an increasing share of those productivity gains have not necessarily gone to workers. So here's what I'm showing you for Canada. This is the US. The blue line is productivity, it's output per hour worked. And the green line is compensation per hour worked. So as we've seen productivity grow and grow and grow and grow, average wages simply have not kept pace. So that income's going somewhere, it's just not going into workers' pockets. So there's a real question about the sustainability of that. So, and you can see new technology and automation, they carry risks too. It's not just a win-win for everybody. Like what I'm showing you here is, in Canada, total employment relative to manufacturing employment. And ever since about 2002, we've lost, I think, something like 250,000 jobs, nationwide. But those aren't ever coming back. Those are jobs lost to new technologies and automation and globalization and things of that nature. And I think what we're seeing today, this rise of populism, is at least in part related to some of these issues: rising inequality, the loss of middle-skilled jobs. Like economists like to talk about this thing called the hollowing out of the labor market. As we kind of move along this technology curve, what we end up automating are a lot of these middle-skilled jobs that are quote-unquote automatable. And what happens is the people that were there, they have to move left or right. They have to go to the higher skilled curve, this kind of more knowledge-based jobs, or they go to the lower end of the skill curve. And that partially is what contributes to rising inequality. So the data here I'm showing you is after-tax income growth by percentile, if you can call it. So what we can see is actually Canada's not nearly as bad as some other places. Like if I showed you the stats in the US, they would be really, really bad. But Canada has done a better job of combating inequality pressures than most countries. But what you can see is between 1982 and 2000, what you see is a fairly significant decline in incomes among this 50th to 90th percentile. So that's kind of like the middle of the distribution, kind of towards the top. So what you might consider to be the middle of the distribution. And the gains have all largely happened in the top 1%. The bottom 50% and this kind of the middle 10%, they haven't seen too much movement. And that, I think, again, this kind of fits into this idea that Canada maybe has done a better job of addressing lower income issues, but hasn't done such a good job about addressing middle income issues. Since 2000, though, there hasn't been too much movement. I think that's counter to places like the US or the UK or other countries that have seen continued increases in inequality pressures, and perhaps what has been a motivating force behind the rise of populism in those places. The one thing I want to mention, this is income inequality. And one of the things that is very lacking in our inequality debate is our ability to talk about wealth inequality. Like, you can be in the top 1% of income, I think, in Canada, and still feel like you're not kind of really at the top, mainly because you have to compete with people who are living off of a very significant amount of wealth that maybe actually don't work. They just live off a certain amount of wealth. So the data I'm showing you here, the people in the highest net worth quintile, so that's the top 20% of Canadians, they hold about 2/3 of all the wealth in Canada. That dotted teal slice is the top 1%, and they hold about 15% of all the wealth in Canada. So there's a real kind of, I think, disconnect between when we talk about income inequality and when we talk about wealth inequality. Wealth inequality is actually much more extreme than income inequality, but income is actually what we're able to track to a much better basis. It's hard to track wealth. But anyway, like if you look at kind of all these issues together, like this is the real challenge for Canada today. You know, we have this aging population. We need to do something about it. Notionally, the answer to that is let's be more innovative. Let's get higher productivity growth. Let's input policies to get all this stuff up there. But on the same token, we need to find a way to address the consequences of that increased productivity growth. And I think up to this point, our policy discussions have ignored that. We just consider productivity to be always good all the time. More productivity is always good. And I think we're now learning, we're now beyond the point where that's necessarily true. And so now we're at a stage where we need to be thinking about this issue in particular. And I think the consequence of that is if we don't, we risk that being unsustainable. And I think we are already seeing that manifest itself quite significantly in our political sphere. Now, a lot of this has been really negative, but I do want to end on a positive note. And that, in actual fact, is Canada, all things considered, is a pretty positive place. Relative to a lot of countries, we are better off than most. And I would say that it's because we have a very strong ability to attract newcomers. I think before the rise of Trumpism and populism and things of that nature, there was actually a very significant competition for international talent. We've had this federal skilled worker program to try and attract skilled newcomers for decades, ever since 1966. But even countries that previously were very anti-immigration, places like Japan, Germany, even they started instituting skilled immigration programs following our lead in the UK and Australia and countries that have had those programs for a really long time. So that's all changed more recently, but that I think is still there, that there's a need for us to continue to attract top talent from around the world. And we're very well placed to do that. We already have a very diverse population, and we're very well known as a welcoming place, and that's actually kind of a strength of ours. We also have the highest post-secondary education attainment in the OECD. If you look at kind of college, university, CEGEP, and things like that, we're a very well-educated labor force, and that's also one of our significant advantages. I won't go through all of these. You can kind of see what's on the slide. But the point is that I think ultimately we face serious challenges, but we're also not alone in that. Every single advanced country in the world is facing very similar threats, similar to ours. Even the household debt stuff. Like, we're not the only country that has a very elevated household debt statistic. Tons of countries in Europe and Scandinavia, Australia, are facing very similar pressures in terms of both household debt and elevated home prices and an aging population and low productivity. All of those issues are very common among our international peers. So the real question is, who figures it out first? And again, we're well placed to do that, but I still think it needs more kind of conversation with folks like yourself about how to achieve that.